Good afternoon, everyone. My name is Demet Çanakçı, Senior Program Director at Toronto Center. It's a great pleasure to welcome you to our executive panel, Supervising the Next Wave, AI and Digital Assets. Since our establishment in 1998, Toronto Center has trained more than 30,000 supervisors and from 190 jurisdictions, helping to build more stable and inclusive financial systems around the world. Artificial intelligence and digital assets are transforming the global financial landscape at remarkable speed. Their convergence is unlocking innovation from decentralized finance and digital currencies to tokenized assets and AI-driven market intelligence, while also challenging supervisory frameworks and raising new questions about systemic risk, market integrity, and cross-border cooperation. At Toronto Center, we work closely with central banks and supervisory authorities worldwide to strengthen their capacity to manage precisely these kinds of emerging challenges. Today's discussion continues that mission, bringing together distinguished leaders to share insights on how supervisors can harness innovation while safeguarding financial stability. We are honored to have with us Sarah Bredin, Deputy Governor for Financial Stability at the Bank of England, Danny Kalyala, Governor of the Bank of Zambia, and Stefan Ingves, Chair of Toronto Center. Our discussion will be moderated by Jay Surti, Division Chief in the Monetary and Capital Markets Department of the IMF. I would like to thank the IMF for hosting us during the annual meetings and to thank our distinguished panelists and all of you for joining this timely conversation. Toronto Center's mission is supported by Global Affairs Canada, Swedish SIDA, and the IMF. With that, it's my great pleasure to hand the floor to our moderator, Jay Surti, lead today's session. Thank you.
Thank you. Thank you, Demet. Good afternoon and welcome, everyone. I'm Jay Surti from the IMF's Monetary and Capital Markets Department, and it's my pleasure and privilege to moderate this conversation on developments in AI and digital assets and the corresponding opportunities and challenges for supervisors. I want to start by thanking the Toronto Center for organizing today's conversation and our distinguished panel of speakers who will offer their perspectives. I wanted to extend my welcome to Governor Kalyala, Deputy Governor Sarah Bredin, and Stefan Ingves, Chair of the Toronto Center. Macroprudential surveillance, financial sector policy, and risk-based supervision are all being challenged by the growing impact of digital technology on the range and reach of financial products and services, challenged in the sense of striking the right balance between ensuring room for welfare-enhancing innovation and competition in this rapidly evolving landscape, and vigilance at the same time to safeguard consumers' financial stability and the continuity of critical financial services. For today's session, therefore, I will ask our panel for their views on how innovation can be harnessed to optimize supervisory opportunities in AI and digital assets. And following this, I will seek their views on managing risks from the perspectives of market integrity, systemic stability, and what demands on cooperation between stakeholders can be expected to be made of all of this. I won't attempt to set a stage for this. I think many of us are actually aware of what is happening around us and what some of the key issues are. I would rather have the panel offer their views and give them the time to do so. So without an appetizer, let me perhaps turn to the first round of questions for the panel. Stefan, if I may start with you. Having observed supervisory evolution globally, how can supervisors harness AI and data analytics without losing sight of judgment, proportionality, and policy intent?
Well, thank you. And first of all, what a privilege it is to sit in front of the such a full room listening to these things. So thank you for coming. Judgment, proportionality, and policy intent. Those three words are not technical words at all. Those are actually dealing with real stuff, what we have to do. And let me start, given that I've been in this business a long time, to say that in the old days, a lot, if not all of it, was on paper. And what did that mean? Basically, it meant that it was hard to get relevant information, particularly in real time. So that when you had to decide this and that, you had to pass judgment based on old data in one form or the other. Fast forward to today. Today you can actually drown yourself in data. You can drown yourself in numbers. And that kind of changes the thing in one way, but not at the same time, not at all in terms of what you have to do. Because then if you drown yourself in data, you have to find a way of actually swimming up to the surface again. And that means that you have to pass judgment. And you have to pass judgment, and you have to understand the technology so that you can understand what kind of data this particular technology actually produces. And then again, you have the same sort of issue in the sense that you need to, as best as you can, to understand what you are what you are doing. In addition to that, when it comes to data availability, I do think it's helpful and can be very helpful when it comes to this issue of proportionality, because we talk a lot about risk-based supervision, and risk-based supervision is basically focusing on systemically important institutions. But depending on where you are in the world, that usually means that you have, in some cases, hundreds of other institutions. And it's incredibly hard to keep track of what they're doing. But with new technologies, it actually makes it easier, and probably also over time using AI, because then you can use technology to sooner rather than later raising red flags among institutions. It is physically impossible to sort of supervise on a daily or monthly basis. And I think that's a very, very good thing, because we also know from experience that an institution which is not systemically important can easily become systemically important overnight if you mismanage these things. But at the same time, it's fascinating to talk about AI, digital, this and that, but technology cannot replace human judgment. Because at the end of the day, if you supervise, let's say, banks, securities markets people, or insurance, whatever it is, you go and talk to the CEO and you talk to the board members. And at the end of the day, it's not about what computers they have. It's about, am I convinced that these people know what they're doing? And that's passing judgment.
Okay. Thank you, Stefan. You've laid out some broad considerations for what both the opportunities are and what sort of job that needs to be done. I want to also gain some specific insights, perhaps, into how this has been approached, or this is being approached in practice. I'll turn to you first, Sarah. How is the Bank of England approaching opportunities and risks presented by AI and digital assets to its core objectives?
Well, look, can I first say thanks so much for inviting me to be here? And then secondly, say that's an awful lot to cover. We could be here all day. So I'll try and be focused on the financial stability aspects, but happy to dive into other aspects. And I do want to advertise a publication that the Bank of England put out just on Wednesday, I think, that it sets out how we are approaching across all of our objectives the responsible innovation in AI, DLT, and quantum. So there's something for you all to go and read if you have nothing to do one evening. On AI, we are monitoring, engaging, understanding, and then using that to consider whether there's more we need to do. So what does that look like in practice? We're regularly surveying participants in financial markets to understand how they are using AI. Our latest survey last year in 2024 covered banks, insurers, asset managers, non-bank lenders, financial market infrastructures. 75% are already using some form of AI. So this isn't an in the future thing, it's now. And that's particularly the case for the largest institutions. And that's a big change on the prior survey, where use was at 50% or thereabouts in 2022. Most of those early use cases are pretty low risk from a financial stability point of view. They're about boosting efficiency and risk management. But what you can see in the survey is that the future use cases are the ones that we will care about from a safety and soundness and from a financial stability perspective. So credit risk assessment, algorithmic trading, capital management, all of those are increasing. What we've been really focused on at the bank when we think about AI is what makes it different. And I'd highlight 5 things. The first is it's dynamic. It updates automatically. Second, it's hard to explain by definition. It's trained on a huge amount of data. It's not something where the inputs and the outputs are easily explainable. It's the ultimate black box. Third, the breadth of data that they're trained on. And I might share a snippet from the BIS Innovations Summit, which is 40% of training data is from Reddit. I'll let you think about whether that's good or not. Fourth, they're prone to concentration. We've got a handful of really important model providers, and that's natural given the computing power and data needed. And then the final thing is that they're autonomous, right? In theory, they can determine outcomes without a person being accountable for what those outcomes are. So that's what makes AI different, and we know it's being used. What are we doing on the back of that? We've convened an AI consortium of AI experts across finance, technology, and academia to share best practice on use cases and to roll our sleeves up to ask ourselves the difficult questions about how this might go wrong. How do you think about governance, model risk, data management in this context? How do we think about herding and pro-cyclicality in markets? How does it matter that we have critical nodes? And the question that is underlying all of that debate is our current regulatory framework enough? We have a tech agnostic regulatory approach in general. Is that approach giving financial firms the right guidelines and guardrails as they go about employing this stuff? So that's where we are on AI. I'm mindful of time. I'll be super brief on digital assets, but again, more than happy to go into it. A similar approach on digital assets, but we as a central bank and regulator have got a much larger role there, because as assets are becoming digitalized and tokenized, they need digital money to go alongside it. And of course, that is the business of monetary and financial stability. We are performing 3 roles in that context. Firstly, soft infrastructure, the rules for stablecoins, the rules for banks as they issue these new forms of money. Second, and we have as well a digital security sandbox where real world transactions can happen in tokenized form. We've had to change our rules to enable that to happen. So that's soft infrastructure. Of course, as central banks, we have to think about the hard infrastructure as well, the trains and the rails of the payment system and the securities settlement system. So that's a second big part of our work. And then the third thing is we have to convene. We have to help lead the financial system through the introduction of these changes to make sure that we're grasping the opportunities and managing the risks as we go.
Thank you. That's indeed quite a lot, Sarah.
Sorry.
Governor, if I may come to you, how do you see AI and digital assets transforming financial intermediation and inclusion in emerging markets and developing economies, leveraging off your experience in Zambia and also more broadly across the continent of Africa? And particularly, what opportunities do these technologies present for deepening markets and improving also supervisory efficiency?
Thank you very much, Jay, for that question. Firstly, let me also express my profound gratitude for the invitation extended to the Bank of Zambia to be part of this forum. So it's really an honor for me to be here. It's quite a mouthful because when we talk of emerging markets and the developing countries, it's quite a range of countries. And I must start from the premise that we are all at different stages on this journey. But what is clear is that we all are inevitably have to traverse that path. So the beauty too also is that there are others who are far along that path. So a lot of learning will have to happen as we go along. And importantly nowadays, I think we are all very much alive to the need to collaborate. So we have a lot of learning, and in some of our countries we are host to big banks, so really that forces us to keep up the pace. Now, definitely we see a lot of advantages stemming from there. But at the same time also we see some challenges, because like Stefano said, this is technology. We are supervisors. So understanding the technology also is something maybe we need to invest some time into and effort. But even if we did that, we will not get to the perfect side. So this is why we are humble about that, to understand what the technologies are doing and how does it relate to the work that we do. Now, there are gaps here of knowledge and the experience that we must bridge. Now, for us on the African continent, we have another added pressure. We have a very young population. So these are people who, with this integration in the world, they follow the trends in UK, here in the US. So they're doing all kinds of things, but which means that we have to up our game. So we think that AI is a tool that can help us to run through all that mass of information. And as my colleagues have pointed out, we now live in a world of now. So if we stick to the old ways of doing things, we'll really be always falling behind. So this offers us an opportunity to really be up to speed with what is going on. But that's a lot of learning as supervisors and regulators to be aware of what risks come out of this. Because the developers of this, they are developing for different reasons. But now we have to combine regulation, stability considerations. Those who are doing this are not considering those things. So that makes it a lot harder for us to keep pace. But it's inevitable. And the financial inclusion, particularly for us, is very, very important because many of our people are underserved. They don't have access to regular banking arrangements. So this offers an opportunity for them to do that. And we are seeing that happening. But to help us navigate this very, very fast moving train, we have also developed, like a Bank of England has done, a sandbox arrangement. That's test and learn. So that we see is offering a lot of good insights because we test these to understand what is going on. So we also learn from all those who are ahead of us some of the challenges that they have first. So I think the aspect of leapfrogging is real in this space. So, but we have to keep going because that's what it is. Now, on the crypto assets part, that's another very interesting thing because what we are seeing in some cases, this is popping up in the space of ransomware. So the cyber risk challenges are real in that space. Now, some of us started up with an advisory that if you are in that space, you are on your own. We are not doing that. But that's not helping because these things are happening on a daily basis. So we are, in that context, working on a comprehensive framework that will help us guide this. Because left alone, we are afraid the trust that we are building could be lost. So in a sense, we have to manage the older generation and the newer generation. How do they both find value in what is happening? So it's quite a task for us regulators, but we are seen sometimes as people who are slowing progress. But far from it, we would want to progress, but progress in a systematic way, in a manner that tomorrow people don't come back and say, where were you when this happened? Because it happens when people get hurt, they will come and say, where were the regulators? So we have that added responsibility to safeguard the environment within which we are playing. So it's like you, as an adult, a child is playing with fire. The child doesn't know that it burns until they get burnt. But so we foresee these problems, but others are not because they are driven by different objectives. So it's a mix that we have to work at, but they offer tremendous opportunities. Thank you.
Thank you, Governor. I think, on some of your points related to some of the risks involved and also in terms of, building and developing supervisory capacity, I will probably come back in the next round. But I wanted to, in turning to the issue of monitoring and managing risks, which is now the second part of our conversation, both Stefan and Sarah, you raised the important issues of model explainability and accountability when deploying artificial intelligence. And so I want to come back to that topic, Sarah, with you. As AI models become embedded in trading and credit decisions, how can supervisors ensure that these vital attributes, particularly when outcomes are generated by self-learning systems like an AI?
So the approach that we've taken in the UK so far is to say that despite the unique features of AI that I talked about, we've got a technology agnostic approach in the way we seek to address those risks. In other words, firms have got to meet our existing rules on data management, model risk management, governance, operational resilience, including reliance on third parties, regardless of whether it's normal tech or AI. And I think that's a sensible place to start, a tech-agnostic approach, future-proofs regulatory frameworks, because we're focusing on the outcomes, what we think matters, and we don't need to have perfect foresight on how technology is going to evolve to deliver them. I think to date that's been a sensible approach. firms have been quite cautious in the way that they've deployed AI in their operations. And in our discussions with firms, including a proper discussion paper that we put out, respondents have said there've been no barriers to the safe and responsible adoption of AI in the UK, which is great news. It means our regulation isn't getting in the way of the potential productivity growth that AI is going to hopefully deliver. But the question I think we have to keep asking ourselves, and we will continue to engage industry closely on this, including through the consortium, is as these AI models get ever more powerful, ever more widely adopted in a wider range of frontline use cases, what are the best practices that we can spread widely in the industry to support their safe adoption? And actually, are further guidelines and guardrails needed? I mean, a big part of adoption of models is explainability. These are the ultimate black boxes in terms of explainability. How is there a risk that by requiring AI models to be explainable, there'll be a nervousness in applying them in the financial services sector? Do we need to think instead about talking about constraints on the inputs to the models and constraints on the outputs of the models? As I say, we've had machine learning as a way of trading in financial markets for donkey's years, and we've managed to be able to put guidelines around that to ensure it's done safely. But I do think on model risk management, on data and on governance, it's worth us continuing to challenge ourselves to see whether more is required. I might double click finally just on governance. A striking finding that came through in our latest industry survey last year was that only a third of respondents described themselves as having a complete understanding of the AI technologies that they had implemented in their firms. A third. That's a pretty low number. I'm not surprised it's not 100%. This is a fast evolving technology, and, you know, learning by doing is a part of what we should expect. But as you point AI to the use cases that matter more and more, credit risk assessment, capital management, I do think we need a stronger, more rigorous degree of oversight and challenge by management and boards. And that's where we're using our AI consortium to help us work out what does good practice look like so we can share it.
Thank you. Lots of food for thought. I want to return to a second point that was made in the first round, which is that the digitalization of financial services and the growing deployment of AI in particular have naturally increased the emphasis on operational resilience. In the face of growing cyber threats, monitoring of market misconduct, and ensuring robustness of financial inclusion by safeguarding trust in financial intermediation. Governor, you actually hinted at some of these points. And so I want to turn back to you. And from a regional standpoint, how can supervisors in Africa strengthen resilience against such emerging technology-related risks while ensuring that innovation can continue to flourish?
Thank you very much. Thankfully, there are the bodies that we have established on the continent to look into some of the areas of common interest. At the continent-wide level, we do have the Association of African Central Banks, which brings together all the 41 central banks on the continent. So we do have a forum where we share different things, including topics like this. So what we do following that is we do some joint work on some aspects, and our staff also have fora where they meet to share information. So this is helping to bridge the knowledge gap amongst ourselves, because like I said, some are more advanced than others. So I think that framework of working together helps to bridge that particular constraint. Then at regional levels also we do have regional bodies. For example, in Southern Africa, we do have the Committee of Central Bank Governors in SADC. That too has a governance arrangement where we, as governors, we meet twice a year, but then our staff are organized in different functional committees, like payment systems, ICT, supervision, which enable them to go into deeper understanding of these issues. So for supervisors, we have the College of Supervisors, and we have strengthened the aspect of this home host supervision. But I know Stefan always brings this up, and which is true, that sometimes when you are under siege, the phone doesn't ring. So we are trying to manage that so that people don't shut you out when you need the support, especially for these cybersecurity matters. What we have now resorted to is that, because at first people are cagey. When you are under attack, you feel if you revealed, you are showing your weakness. So people would sit on that information. But we are encouraging each other to really be open about it, because you not speaking out, you are actually endangering everybody. So what we have found out increasingly now, people are more open, and we see that you may not understand that you are under attack, but these can be there for a long time before they come to surface. And sometimes the information doesn't even come from within ourselves, but it's the industry who point out and said, have you seen this going on? So what we are saying that when you have the such information, share, and then we are also developing capacity to intervene wherever we can get that resource. So this is helping to curb this. And what we are saying too is that when you are under attack and you identify the person, the perpetrator, that information should be made public to all of us, so that we don't. And domestically too, we have made it a point that the banks and the institutions that we supervise, they should also be open to sharing this. So on II, I mean, that's relatively new, but we see that it's going to improve a lot of operational efficiency, as you have pointed out. That too, we are trying to do it from a regional perspective as well. So we share tasks. One does this, and then share results of that. So all in all, what I can say that we have a mechanism of working together, and I think nowadays collaboration is key. And what we see, like these crypto assets, they are not national, they are international. So if you stay still, you get hit by what is happening somewhere else. It's like when we had the COVID, you may not be affected directly, but through the supply chain arrangement, you get affected. So it's the same, we think, in this, that it's in our best interest to really be open to each other, and it's a public good in a sense. It's where there's some public nuisance on the one side, but there's a public good once we term the issue. So this is what we are doing. I think we have some mechanisms for collaboration at a regional level.
Can I add one point on that? I think it's, as this new technology comes in, sharing examples of where things have gone wrong or nearly gone wrong in the way that we've got used to sharing information on cyber threats. I think that will be really helpful because then we'll all know what to keep our eyes open for. So one of the things that we're exploring is how do firms get to a position where, as they share kind of cyber threats, do we share information on where AI has done unexpected things?
So, but one point to add, sorry. Yes, it just reminded me at the global level, there's the Financial Stability Board, but what they have done too is to have regional consultative groups of financial stability. So that also rotates among the regions, and we are plugging into that. So that is helping also and we think it's contributing to the broader understanding of some of these issues. Okay, Stefan, please.
So just let me add a sort of reflection on this issue about technology and new technologies, and we need to be mindful of the fact that the IMF has 190 jurisdictions as members.
191.
191. Okay, I missed one. But so in most cases, most jurisdictions will not have the capability to build these systems themselves. It's only in very large economies that you can put it together on your own. And that means that in a good number of cases, it will be absolutely necessary to cooperate just to keep costs down, to use in one way or the other, share the same system, in addition to the information sharing as such, because it is not realistic and it's not meaningful for everybody to reinvent the wheel again and again and again. But that's quite a challenge, because most supervisory agencies and central banks are sort of trained to think about these things from a very national perspective.
Yeah. Great point. I was going to actually ask you, Stefan, about what kind of international collaboration or standard setting mechanisms would be needed to prevent fragmentation and regulatory arbitrage. But maybe in a way you can just elaborate on some of the things you began.
Yeah. The thing is that, first of all, of course, one needs to come to a conclusion whether it's a new financial or technical phenomenon, if I call it that, if it's important enough, or if it's okay if people lose a lot of money on their own because it doesn't affect others. And eventually these things grow and get to a size such that it matters domestically, regionally, and at some level it becomes a global issue. And that, of course, raises the issue then what to do, how to do this. And I'd say that two words: transparency and follow-up. Because that's what you do in order to understand what is going on. And most of the bodies that are dealing with this type of work, they exist already. So it's not that we need to invent more international meetings or anything like that, because we do have the machinery. But then we should try our best to put the machinery from this perspective to good use. And let me just pick a few examples, like the Financial Sector Assessment Program of the IMF. That means that eventually somebody is going to show up from the IMF and ask, "But what are you doing?" And in the future, you're gonna have to ask questions about AI and digital assets. And that's how you create kind of a database and understanding of what is reasonable best practice. How do you actually do these things? The Basel Committee still does its compliance reports. Are you completely off the mark, or is it reasonable what you do in relation to what has been agreed in the past? The Financial Stability Board's recent crypto review, which came kind of 2 days ago or something like that, it's an excellent example of trying to understand and keep track of what is going on and reflect on to what extent there seems to be holes in the system that we need to plug with better information, different governance structures, or at least getting to a point where we can agree on something. But having said that, in a complex and complicated world, there is not always a willingness to get to consensus. It's sometimes actually the opposite that holds. But in that world, I have realized over the years that plumbers like to talk to plumbers. And that's why you should do your best to keep that conversation going. And if plumbers talk to plumbers for a long, long time, they tend to talk about the same thing and then take to think about things in the same way. And that is enormously helpful. But that also means that, let's say, under the present circumstances, from time to time, you have to accept that you go to international meetings where absolutely nothing happens. But the
plumbers were talking to each other.
Success. You made the point, Sarah. Success is the meeting itself. Because sooner or later, bad things happen, and it's going to be high value that you actually know how to talk to each other before. Because otherwise, you just lose time, it gets difficult, and the whole system sort of disintegrates because everybody is running off in their own direction. And that is not a good place to be, given what we have heard on this panel, because in the old days, you used to put gold bars on a boat, and it took months and months.
Yeah.
Today, everybody has access to everything, everywhere. So like it or not, we're all of us in the same boat, and we better keep talking, even if sometimes nothing happens.
Okay. I think it might be time to go to the audience, but I'm going to use my privilege to ask one more question. And I think this is for anyone on the panel. I think this issue did come up in a couple of your interventions, which is the issue of supervisory skill sets. And, we've tended to ask this question to ourselves. We asked this to ourselves when Basel II came around, and the need for quants in supervisory agencies increased drastically at the same time that there was a higher demand for it in audit firms. And I think we are at that point again in a different way, which is, are today's supervisory skills adequate, or do we need a more tech literate supervisor? Anyone or everyone?
Can I try?
Yes, please.
Yeah, it's a big challenge because the changing landscape means we have to constantly retool. There are so many things that are going on. For example, now we have also climate change issues, so we have to double up there. So really, it's a journey with no final destination, because as we do these things, other things come up. So we keep adapting to that. So the aspect of training, capacity building, I think is an absolute necessity. And also interchanging staff. I think seconding people to different institutions is another way in which we can strengthen our local capacity. Because given the interconnectedness of the globe now, where there is weakness, that's where maybe, because we have to avoid this regulatory arbitrage as well, because that's where they'll hit you the most. So I can just say, in a nutshell, training, capacity building is a must and on an ongoing basis in different skill sets. Thank you.
If I may build on that, I absolutely agree with what the governor said. I would add that kind of this is a continuation of a journey, right? This isn't a brand new thing with AI. We've been having to get up to speed with cyber issues, operational resilience more broadly. So that increasing need for tech awareness, tech capability it's not a brand new thing. The thing that I'd say in our experience has been helpful with AI though is having a go using it ourselves. We use it to read all the board packs that come in. We use it to help us do nowcasting in our monetary policy making. So using it in how you go about doing your job is something that can help, as well as capacity building and secondments.
We have adapted to many new things in the past, so we will adapt to this one as well.
Thank you. On that note, I think we can... Yes, please. No, I think somebody will come with a mic.
Yeah, I'm loud enough without this. But anyways, I think at the end of the day, we're talking about stability, integrity, and prudence in supervision. And one thing we have noticed in the post-2009 era is a reaction from supervisors. One of it is SR 11-7 in the United States. And in the United States, at least, model explainability has become a major thing. And my question is, you guys talk about AI, using AI. Do banks in your area, I'm not aware of any bank that uses AI for credit assessment or for any risk. So is there any practical work happening in the banks, at least not in the United States, but in your areas?
I'm happy to start on that. So the data that we have suggests that there is some use of AI in credit assessment and indeed in insurance underwriting as well, but with a human in the loop rather than it being wholly on the basis of AI. One of the things that I think is a challenge as we look ahead, as increasingly firms will want to drive greater efficiency and agentic AI is a really good example of taking humans out of the loop. A challenge for us is going to be, what does model explainability look like in this context? What are the requirements on the inputs to models? What are the tests you want to perform on the outputs of the models that give you confidence that while you don't understand the neural network and the end data layers that sit in the model, you do understand what's going in and what's coming out?
So you might as well just very briefly. I think, at least in the context of the United States, the ML models are pegged against the old regression models, logistic regression models. And the test has been, does it perform as a challenger model? Does it perform as well as the scorecard model? And I haven't seen any machine learning model that's actually used without that pegging per se.
I think there were some other hands here as well. Yes, please.
Thank you very much. Thank you very much. Great panel. I'm Eric, and I work for a think tank, CGAP, that focuses on financial inclusion. Mr. Ingves, you said plumbers like to talk with plumbers. So I would agree with that. But I would also ask the question, do plumbers also need to talk to carpenters? Because what I'm seeing here is that there are many different new players that are intervening in the financial sector. There are authorities also that are emerging, for example, data protection authorities that also look at some of the aspects of the financial sector. So what types of mechanisms do we need in the future to ensure, better stability, less risk also for consumers from my perspective? And I think, Ms. Bridden has talked about the consortium on AI, for example, but can we go beyond that? What are the new structures that are needed in the future?
Okay, Stefan. Yes, let me try to give it a try. First of all, there is almost nothing new under the sun when it comes to money. And most people don't understand that, particularly those who come from the tech side. And in addition to that, technology does not define money. It's a legal framework that defines money. And that means that creates, in addition to plumbers talking to plumbers, your example is a good one. You actually need to understand who are the interested parties involved in this, so that you talk to all the interested parties, because without that, it's likely to go wrong sooner or later. And it's striking when we talk about AI, we talk about digital currencies and all those things, that ultimately at the end of the day, and that happened in many countries already more than 100 years ago, it's the parliament that decides what is money. And that means that you have to have the ability and the willingness and the capability also to explain to laymen, lawyers and others what you are up to and why doing it in a certain way is to the benefit of society as a whole. So it goes way beyond the technical issue as such.
Might I add one thing, and this is pointed at AI rather than digital money. One of the things that we have sought to do is engage with the bit of government that's thinking about AI broadly across the economy. So in the UK context, we have an AI Security Institute, and a number of the issues about ethics, about data, those kinds of concepts are a horizontal set of issues across the use of AI broadly, kind of, whether it's used for military purposes, for biotechnology purposes, never mind for finance purposes. So I think the plumbers do have to talk to some people in other fields as well, because some of the issues are common, but there's real value in talking to plumbers from other jurisdictions at the same time.
Yeah, I just want to come in to add to what Stefan has said over money. I think this is an important clarification, because even now, why do people who are developing these elements which look like money come to the central banks? Why? I think that's one of the important things to ask. Why do they come? I think that's where it will get the blessing to have that meaning that it is money. So I think we have to talk to each other necessarily, but then we have additional responsibilities which may frustrate those who are thinking that's the money thing that they are doing, but we have to understand each other why that is important.
There was a question there, and then...
Thank you. Brad Carr from National Australia Bank. Sarah, you're the one person this week I've heard mention quantum. So congratulations, because I think that's one of the big looming topics. Just curious in terms of the expectations you'd have and the focus there. Is it firstly and most urgently around quantum safe encryption, ensuring adopting the NIST algorithms, etc. there? And then beyond that, the opportunities around perhaps quantum to enable different kinds of modelling that might help to enhance fraud detection, for instance. I think HSBC in your jurisdiction has been one that's been quite vocal about some of the opportunities that they see there. Just curious if you can elaborate on where the priorities and the opportunities are.
Happy to do that. And so far, our focus, as you might expect, given we are professional catastrophizers, is all about how might quantum lead to cryptography and security being challenged. We've started engaging with firms in London about how they are going to get ready, being really clear that we should expect there to be, by the end of the decade, the ability to challenge cryptography. And so starting now to drive through the changes to systems to ensure that we are all ready for that. I think of it, I don't know whether this is helpful or not, but a bit like Y2K, that we know something is coming and that we need to be ready for it, working with industry on the most critical systems to ensure that they are ready for when cryptography is challenged by quantum computing. You're absolutely right. Of course, there's lots of opportunities as well, but let's kind of make sure the fences are in order first.
There was another question.
Good afternoon. Thank you so much for being here and for the excellent presentations. My initial question is for Governor Kalyaya, and then after that to Mr. Furty, Deputy Governor Breeden, and Mr. Engves in turn. Rex Wempen, Intelligent Infrastructure Corporation, providing a suite of AI, DLT, and advanced computing solutions to institutional and sovereign clients. First, Governor Kalyaya, what are your plans in Zambia for tokenization of assets and for the introduction of stablecoins, to the extent you're able to comment on that? And then to the rest of the panel, what's the breadth that you see around the world? Obviously, we have Stablecoin and Genius Act in the U.S., and then you have many countries which are thinking about what to do next. Thank you.
Thank you very much. I did indicate that we are developing a comprehensive framework. So we are early in that journey. But in terms of developing that framework, we are almost there, which will guide how we are going to handle crypto assets in general and the stablecoin in particular. So all I can say at this point is that just give us some time. We'll be able to share our views on how we are progressing in that direction. Thank you.
And so, look, it's been the topic of the summer, hasn't it? Stablecoin summer, and kind of it's been a big topic of the debates here at the annual meetings. And as Stefan mentioned, the FSB has just put out a report that sets out really clearly where different jurisdictions are on implementing the global standards for global stable coins. Some jurisdictions are there and have regimes in place. Others are in the process of developing them. I might mention one thing about the UK's approach, just because I think, well, I'm marking my own homework, I would say that. I think it's an important perspective that we're trying to bring to it. So as we're thinking about our regime for stablecoins, for non-bank digital money, we're thinking about not just how stablecoins are being used today, but how they might be used in the future, right? The regime that you would design for $200 billion worth of stable coins will be very different to the regime that you would design for $2 trillion worth of stable coins. And so what we've been doing at the Bank of England and in the UK is trying to think through how might stable coins be used more broadly. And in that context, what does a safe regime look like? It goes back to Stefan's points and the governor's points about what is money, and ensuring that if $2 trillion of stable coins are going to be used as money, we are putting a regime in place to deliver that trust in money, so that $1 of stablecoin is worth $1 of my money, or a pound of stablecoin, pound of central bank money, pound of commercial bank money. That takes a bit of time, but we're trying to fix for the future, not just the current uses.
Let me add to that one underlying issue, and we don't have the answer to that yet, is to what extent you tokenize everything. And if you tokenize everything, it's very hard to understand what the value added of stable coins is. Because if you tokenize bank deposits and if you tokenize money market funds, then we are moving into a completely new world. And as I said, there is nothing that we have. Few things are new under the sun when it comes to monies using the plural. So we haven't quite seen the end result of this as of yet. And if you think about this in global terms, I'm pretty sure that over time some stable coins will change name to unstable coins. And that's why we have central banks in this world. And that will continue.
I don't know if you have time for one more question, because I know Debir's been waiting for a while. But
thanks a lot. And first of all, great conversation. 2 quick questions. So it might be, listening to all of you, that we might be heading towards what one can call a digital or a more intelligent Bretton Woods system. And in that context, I'm just looking at to what extent is attention being placed on the overarching institutional scaffolding within which all this innovation can take place. I'm talking here specifically about the international monetary system. Because if that is not in place and that's not being thought through, then we can keep on talking about a lot of plumbing issues, systems, design, but it's not going to work. And even regulation and supervision will be effective only when that thing is in place. The second quick one is, the more I think about it, the more I feel this is an issue of speed. The pace at which this is happening is absolutely mind-boggling. This is not like happening, this is not playing tennis. This is accelerated squash playing on the court. And that has to be reckoned with, because I wonder, in that milieu, is supervision possible at all? And if not, then what has to be thought through? And seriously, it could be in a very dynamic way. 5 years out, we are sitting in a completely different mode. Thank you.
Look, let me give you my 2 penneth on that. I think that these the issues of money that we are talking about have got the potential, if not handled well, profoundly to change what happens in domestic financial systems and in the international monetary and financial system. And that's why it's been the topic du jour while we've been here. So I think the issues are deep and profound, and we need to get our arms around them. On your point about the pace of change, can supervisors keep up? Maybe we need to get better at using AI, so we've got agents all over the pitch doing our job for us, even as we sleep.
Thank you. On that note, I think I just wanted to thank the panel for their excellent conversation and their views, and ask for a round of applause.